In this video, I thought you would appreciate it if I shared my analysis of Huntington Ingalls Industries. I recently did and posted on my website manalov.co.uk. Huntington Ingalls Industries. I came across that company by looking at Vitaly Katsenelson's recent 13F, um, which I think he filed in the beginning of February. I've been a regular follower of his work, of all his articles. I read his books, and I follow his website. And I think he's a brilliant value investor, contrarian value investor. So I was rather curious as to why he increased his position in Huntington Ingalls Industries by around, I would say maybe 50, I think 50%. Let's have a wee look there on his 13F. So this is where I'm following it. It's whalewisdom.com. It's a really useful website where um, you can pick an investment company or hedge fund. I think you can follow as well, and you can just go into their holdings and have a look and see what are their most recent purchases, what they sold, which positions they added to, and everything. So, how do we look there? Okay, so I could see that he disposed of a few companies. There are actually quite a few companies, but what really attracted my attention is that you see here he added 45%. He increased his Huntington Ingalls position by 45%, which is pretty much the biggest change he made in the last quarter. So that sparked my curiosity. So I decided just to have a wee peek and see what the company does, because I was not really too familiar with it. I knew it was a just a defense contractor, but I had absolutely no idea of exactly what it did. If it was a manufacturer, if it was developing artificial intelligence for the U.S. government, I had no idea. So I spent the last, let's say probably the last week digging in and putting together all these facts and figures, which ultimately led to my decision of whether I wanted to add it to my portfolio or not. Right, so Huntington is a military shipbuilder. As of 13th of February, which is when I started writing the report, they had a market cap of 6.4 billion, price to earnings of 13.4, which actually was not too bad. Their free cash flow this year was rather low, so I did a bit of digging, and it turned out it was caused by, if you notice here, I've included some clarification onto that. So their price to free cash flow was 160 times, right? So they only had like 26 million or something they made last year, whereas previous years they were making upwards of half a billion in free cash flow, which is what I pay attention to. It was rather interesting for me to see what happened there, and it turned out that this was caused by a change in working capital figure for 2024, which was mainly because of a deferral of accounts payable. So basically, they didn't pay. They had an agreement, I'm assuming, with one of their suppliers. They didn't pay them last year. They paid them this year, which obviously incurred a massive change in capital. So that's why. That's really why. Nothing to worry about there, which is a good thing, I guess. Price to free cash flow, the 10-year average was 13.3, which is not too bad. Not too bad. I mean, these figures really mean nothing unless you compare them to their competition. So price to free cash flow for 2025. So they had a forecast, 2025 forecast for cash flow, and that was between 300 and 500 million, which for me is a rather big range. You know, between 300 and 500. That's a pretty, like, 200 million. That's a pretty big range. Anyways, price to free cash flow for next year will be between 12 13 to 20 times. Dividend, 3.3% dividend. It's fine. I don't pay attention to dividends too much, if I have to be honest. it's my own personal preference. I prefer to see a massive amount of cash flow or a better price to free cash flow ratio than a hefty dividend. So what do they do? Huntington Industries. Oh, before I start, you have access, free access to this analysis on my website here. I'll share it down in the description of video. So please have a wee poke, have a look. And if you like the content, if you find the analysis useful, please consider subscribing, liking the video, dropping me a like, or maybe a comment down below. Right. So business description. Huntington is basically America's largest shipbuilder. Their biggest, by far the biggest customer, and I would arguably say their only customer, is the U.S. government or the Department of Defense. 95% basically of their sales come from contracts from the US government. That figure was not officially posted on the 10K, but I managed to do a bit of digging, and you can easily see there. You see, this is their, what's that? That's their contract sales during 2024. US government by far the biggest, and then accounts receivable again. That's basically it. The company operates in three segments. Ingalls, which is their non-nuclear ship design, construction, repair, and maintenance businesses. Then you have Newport News, which is the nuclear segment. Again, same thing as Ingalls, but they build nuclear ships and submarines and maintain them, refuel them. And then you have Mission Technologies, which is basically development of software products and systems and basically add-ons onto their other two segments: cyber intelligence, surveillance. All of this is here. By size, the Newport new segment, which is the nuclear production, nuclear ship production design fueling segment, is the biggest. It brings in nearly 6 billion. It brought in nearly 6 billion in 2024. Mission Technologies, second biggest, brought in half of the revenue compared to Newport News, and Ingalls brought in 2.76 billion. That's all good. But let's have a wee look at which business segment is more profitable. Ingalls is by far the most profitable one. That has a 7.6% operating margin. Mission Technologies 3.9, Newport News 4.1. So I would say that these are rather small margins, but again, these figures mean nothing unless you compare them to their competitors. Capital deployment, that is it looks like they're doing a decent job. They're buying back shares. They have that 3.3% dividend, which seems to be well covered. Historically, share buybacks, that was actually that I found rather impressive. So HII was spun off from Northern Grumman in March 2021. So since then, they've bought back 19% of their shares, outstanding shares, which is rather impressive. I quite like that in a company, as long as prices are bought at the right. Sorry, shares I bought at a good price. They've not, as long as the company is not overpaid. So 19%, that's good. If in March 2011 I owned one share, they had 100 shares, I'll have 1% of the company. And 2024, I still have that one share, but they bought back 19% of the shares. So you can imagine, I am entitled to a bigger chunk of that free cash flow, in theory. What else? Dividend growth, decent dividend growth. Past 10 years, been growing quite a bit. So again, dividends are a nice thing to have, but not a necessity for me. 2025 forecast, as I mentioned earlier, they predict between 300 and 500 million in free cash flow. which is not too bad. Another thing, their backlog is rather impressive. Um, I mean, I wouldn't buy the company just because they have a massive backlog. I mean, the backlog means that they have a secure work basically for the next few years. 48.7 billion backlog. This, as you will find out a little bit later in the analysis, is the biggest from all the competitors in this part of the defense industry. They have the biggest backlog. Again, that doesn't really mean too much. Um, if they can utilize their capacity and actually build those ships, so they have some, workforce shortages or some other problems, then that means nothing. Uh, Here I've put a quick ship procurement process description just to give you an idea of actually how does it work. How does the government buy a a $4 billion submarine, for example, or anything. But that was rather interesting. I won't bore you with that. I'll go straight into the risk factors here. I've put together 9. I'm sure there's more, but these are the most obvious ones. First one, again, uh, obviously, is the fact that 95% of the company's revenue comes from the U.S. government. That is not ideal. But on the bright side, as I've mentioned here, Huntington is part of a duopoly, which has an incredibly high barrier of entry. So I wouldn't be too worried about that unless the US government decide to put together a department that builds those submarines and ships for them. I'm not worried about Huntington going out of business for now. What else? What else? They have very low gross margins. Raw materials you know, can impact raw material prices, can impact their margins. They can get squeezed. So that's something to be mindful of. Labor strikes, again, if their production line grinds to a halt because they don't have enough people to work there, obviously that'll be a massive problem for them. The company that's an interesting one. The company has classified contracts with the U.S. government, obviously, so not all of their business is very transparent, which means like there's some stuff that they can't share, even though it's a publicly traded company. Some stuff they can't share. The company, obviously, workforce. Company depends on recruitment, retention of qualified personnel. One thing to bear in mind is that lower class, those people who are welding, basically, that's still bottom of the ships, or lower level workers. They can easily branch out, go and find a job, basically same job at another company. They can well go and, I don't know, weld what, you know bridges, or working just lower level jobs, where they can find better money. Um, an ability to inability, apologies, to expand their current and future shipbuilding capacity. Yeah, obviously that's a big risk there. Security threats, obviously getting hacked. I mean that's pretty much every company these days has that risk. And natural disasters, wildfires, especially wildfires as of recently. It's been happening in the U.S. Earthquakes in Greece, storms in the U.K. So in terms of performance metrics, I put together those here. These are the 10-year averages. PE 10-year average 14.8, which, if you have a look here, their current one is what, 13.4. So that's below their 10-year average. That's interesting. Certainly, gross margin 17.8. This is, don't know. I guess that's a little bit low. Not too sure. Operating margin average is 8.43. Last year was 4.20. So that is basically 50% lower than their 10-year average. So something's going on there. Net margin is again lower than the 10-year average. Last year, like I said, don't pay attention. That 0.2, that was affected by the deferred accounts payable. Return on equity, 30%. That is actually quite good. Return on invested capital, 50.5%. I like that. I certainly like that. Competition. So basically, like I said, it's a duopoly. So it's basically General Dynamics and Huntington. BAE is not such a big player, but they still produce military vessels for the US government, so I've mentioned them in there. Again, General Dynamics and BAE are, as you see here, they're massive compared to Huntington. They're massive players, but that's because they have other divisions. They operate internationally. They don't do military ships for the U.S. government only. So you can see their market cap size. Obviously, that's can't really compare that. 47 billion and 29 billion. This is their revenue, maritime revenue. So that is just the shipbuilding segment in each company. Obviously, Huntington being just purely shipbuilder, then that's all their revenue. General Dynamics, they have quite a lot of revenue. Again, BAE as well. Free cash flow, 10-year average. You can see it here. That is not too bad. Then you have the 10-year, sorry, the current P, 13.4. Look at these two. These are rather expensive. Again, 10-year average PE. The Huntington being the only one below its 10-year average. Martin operating margin. So this is where it struggles. This is where Huntington is struggling with their 4.6% margin. That is not ideal. Free cash flow, not doing great either. Maritime backlog, like I mentioned earlier, they have the biggest backlog from all three. There's other companies that are shipbuilders or have something to do with the defense sector, bigger players, but I'm not going to go over them. They're not direct competitors, nothing to worry about them there. What some interesting sector findings I found is that based on the current geopolitical scenario, it looks like growth at an average of 2.6% is expected over the next few years, which is basically what I've kind of used in my valuation, which is nicely coming along in the next section here on the analysis. I have went for this is the current 10-year average. So this is the 10-year average free cash flow. So that's the figure I've used to start my projections from. Growth rate, I've done 3% for the first 5 years and then 2% for the remaining 5 years. Discount rate 13%. Maybe I should have increased that a little bit. Not too sure. Terminal multiple 15. Now what was their average there? It was 14.8. Yeah, so I've just rounded up to 15. This is the normal case scenario. Then we have the best case scenario, worst case scenario, with the figures growth, assumed growth rates here. This is their average share. This is their shares outstanding. That is my margin of safety there, 20%. I feel like 20% is reasonable. I know they're not going to go out of business. I know they have a massive backlog, so they'll be kept busy for the next few years. So I'm not too worried. I'm going to give a nice 20% margin of safety for that, which means that my price for the company is currently sits at $116. So that is quite a bit below what I would expect to see. Finally, verdict again. I think you already got the gist. Um, I think there's better investments out there. I think there's better places for me to put my money in, get better returns. Again, as I told one of my friends, if someone put a gun on my head and said you need to buy a defense contractor, a U.S. defense contractor, I would go for Huntington for sure, without a doubt. I mean, they're a solid company. They produce cash flow. They're part of a monopoly, a duopoly, which is ideal from an investor's perspective. But their margins are not great, you know, and I don't have a gun pointed in my head, so I think I will put them in my watch list. I'll add them to my watch list at 116 and keep an eye on them. So yeah, that was my analysis of Huntington Ingalls Industries. Thank you for taking the time to watch my video. Really appreciate you. Please consider subscribing if you found this useful. Visit my website again. It's available. It's all for free. So please have a look, and you're much appreciated. And I'll see you in the next video.